Yeah, as already said, happy to introduce Elizabeth Pollman to you from Penn Law School. She'll talk about startup failure, and very excited to hear. Thank you.
Thanks so much. Everybody can see my screen, I assume, with my slides. I'm Elizabeth Pollman, as Simone said. I'm from Penn Law, and the paper is Startup Failure. And I'm so glad to be a part of this. This is an excellent conference. I thank Casimiro. I thank all of the organizers. It's been fantastic so far. Ron's keynote was excellent. And in many ways, since the conference is so coherently organized around themes, we get to explore different avenues of this. So this project is about one of the paths that's most common for startups. So venture-backed startups famously aim for exit. And successful exit for startups is often framed as reaching a liquidity event that provides financial returns to the investors, founders, and employees. And that's usually done by either going public or selling the company. And each of those two paths are the subject of significant scholarly study and public debate in recent years. But most venture-backed startups never reach either of those paths, or if they do reach an M&A deal, it's in distress. And that, in some ways, I think ties to some of the themes that Ron was getting at in his keynote, that when you have companies aimed at innovation in an environment of uncertainty, what I'm getting at is that a lot fail, and it's difficult to estimate the true number, but by some estimates, 70 to 90+% of venture-backed startups fail. And they can do that for a variety of reasons. They run out of money, or they have problems in the team, or shortcomings with the product development or their business model. They get outcompeted. So many different things can lead to this. In many instances, the startup just never reaches profitability, so the failure to be able to raise another round of venture financing or debt means the end of the road for the startup. So that third and most common path for venture-backed startups of failure receives relatively little attention. And in this paper, I argue that it's a critical part of the venture capital and startup system. And what I'm looking at is, with this large number of failed startups that we're going to have, how do law and culture facilitate dealing with those? And to say just a bit more about what I mean by definitions, because this isn't a legal term of our startup failure. It's just a way of getting at the concept of studying startups that don't reach a successful end. And by that, I mean the idea that most would at base, as a common denominator, be aiming at getting a financial return for all of the participants that are in the cap table. And so if they don't reach that goal, then I would call that a failure. But to be clear, most startups are often in a state of distress. So I don't just mean distressed. And I don't just mean an exit, because many exits are actually those that don't produce financial return to all. So what I'm getting at is this idea of startups that are not producing financial return to their participants. There may be other benefits to these startups. Indeed, for many, the motivation for entrepreneurship and the way for startup participants to characterize their activity would be by saying that they've produced some kind of good for the world, some innovation, et cetera. I'm not debating that in any way. In many ways, that's part of my point, is that there's lots of ways for people within these startups, even ones that would financially fail, to characterize that in various ways. So what does it matter how we deal as a society with all of these failures? Well, it matters because it affects the ex-ante incentives to invest in or extend credit to these startups. It affects the labor economics of the great number of entrepreneurs and employees that work in the tech and innovation sector. And that affects the flow of talent and technological know-how, and the incentives for entrepreneurs to remain connected with their IP assets or start afresh in new ventures. So it matters why we deal with this in a way that could be efficient and good for the participants in the system. And the big picture of failure we often think of in terms of bankruptcy, but for various reasons that I explore in the first part of the paper, bankruptcy is not commonly used by venture-backed startups. And the literature hasn't explored this before, but I point out that there's a few reasons why the formal bankruptcy process is not a good fit, in particular for venture-backed startups. And that's because in many instances, these companies don't have significant commercial liabilities that need to be satisfied. The primary expense for many startups are the employees themselves. And startup employees are typically at will. They don't have employment agreements that create some kind of fixed ongoing obligation for the company, so they could get laid off quickly. Depending on the startup, it may have real estate leases or cloud server contracts or some type of operational expense, but those often don't represent significant outstanding debts. They also typically don't have cap structures that push towards bankruptcy. They have a small number of creditors in many instances, and those usually aren't a huge amount of the capital structure. The paper goes into more detail about that, about the financing of typical venture-backed startups. But another reason, in larger part, is that startup financing connects to the larger picture of the nature of startups, which is that they're melting ice cubes. And they're melting ice cubes in the way that the team's talent and technological know-how are hard to value and can disappear very quickly once it becomes known that the startup is in distress. The employees can flee. They're often unbound by non-compete agreements. Competitors monitor those situations and actively recruit from failing businesses. The stock options and RSUs and common stock that's often used to retain or motivate employees and founders is usually worthless in distressed situations. And not only is the startup a melting ice cube, but it's a melting ice cube embedded in a network of reputational concerns and constraints. Angel investors, venture capitalists, venture lenders, they're repeat players in venture lending and investing. And opportunistic conduct gets constrained by reputational concerns in this system, particularly in a competitive environment for getting into startup deals. And when there's a symbiotic relationship between the venture lenders and the VCs, it's not worth squeezing the last dollar back from a startup if it affects somebody's reputation. Further, the VCs typically invest in portfolios of startups with the aim that a small number will deliver home runs that drive much of the returns for the fund, and that's known as the power law of venture capital. So the business model of VC isn't to squeeze out the last dollar from all of the failures, it's to focus on the ones that will drive the returns. So typically, once they perceive that the company is unlikely to drive the outsized returns, board members affiliated with VC funds might have incentives to shut down startups or find other exit paths that won't require their continued attention. So a long, drawn-out bankruptcy process is often the last thing that a VC wants to be involved in, given the opportunity costs and reputational concerns. And explanations all go beyond the typical explanations of why bankruptcy might not be appealing to businesses for it being expensive and time-consuming, and those also apply to startups as well. So in sum, for most failing startups, the bankruptcy system just isn't a good fit because of the nature of their business and capital structure. And even when it might hold value, there's reputational and cultural factors that might push against its use. So the first part of the paper, as I mentioned, explains why bankruptcy isn't a good fit for most startups. But I wanted to look at the exceptions of when startups do use the formal bankruptcy system, because I had been hearing some media reports about some, and that really piqued my interest, because when I practiced as a startup lawyer, I didn't see very many formal bankruptcies. So it made me interested, because I thought it just isn't a very good fit for the reasons I explained, but you actually do see a few. And the literature on this is really sparse. There's one study from Ronald Mann in the dot-com bust era about 20 years ago. And what I do in this paper is I hand collect a set of bankruptcy filings that's generated from Finding First media reports. And I look at these and I find that they really fall into a few different buckets. The first bucket are companies that have really significant legal issues. And this might be that they had a legal issue right at the center of the business model of the company, like Aereo, that had a copyright issue at the center of its business model that got litigated all the way up to the US Supreme Court. Or it could be companies like Ubiome that had legal issues that came up where Ubiome got investigated by federal regulators and their offices raided, et cetera, that were very significant legal issues for the company. The founders fled, et cetera. So there are a few companies that have legal issues that are significant enough that seem to push into a formal bankruptcy. There's some companies that just seem to not manage the runway of time that they had. And so they use the formal bankruptcy system as a pivot or last ditch option that allowed for a changing direction or having a rebirth of the company. There's a few situations where the company seem to just not have the typical cap structure of a venture-backed startup, or they had taken debt from a different type of lender. For example, a company, 38 Studios, had taken money from the state of Rhode Island, so they had taken public money. Some states have used public funds to try to facilitate entrepreneurship and try to encourage employment and other things in their states. And in some instances, when you have debt that's coming from these sorts of sources, or those sometimes it may be that they're East Coast versus West Coast types of scenarios where some lenders might be more willing to push companies into bankruptcy. And finally, I found a few instances of what I would call the big startup scenario, where you have companies that have taken on really significant amounts of funding, sometimes $1 billion or more in funding. And those really behemoth companies that strain the label of startup in some ways, when they encounter financial difficulty, they have sometimes used formal bankruptcy. So all of these, I would argue, though, actually point to in a sense, the exceptions that show the rule. These aren't the typical types of startups. So you do see usage of the formal bankruptcy system, but it's typically when they aren't the usual venture-backed startup, because they've either taken on different types of lenders or really large amounts of money, or they've encountered really significant legal issues. So if they're not usually using the bankruptcy system, what are they doing instead? So the second part of the paper looks at that question. And I point out that the literature has actually examined a number of these pathways, but the literature hasn't characterized this or thought about this as a system of dealing with failed startups. But really, you can think of M&A exits, acqui-hires, assignments for the benefit of creditors, which are known as ABCs under US state laws, and also shutdowns and dissolutions as the way that we deal with these very large numbers of startup failures. And you can think of these as well as pathways that you can compare. So for example, M&A is usually the first preference for startup participants, that when the company realizes that it's headed into some trouble, it might look for a buyer. If it can find an M&A deal, that's usually the best situation. The literature has focused largely on these situations as a matter of fiduciary issues, because they can pose significant fiduciary complexities for the startup board in particular when they're in a situation where the common and the preferred are in conflict over the exit. But there's a lot of nuance even in the M&A exit, as in some instances what's going on is an asset sale. There was a recent example of this with the situation of Quibi, which had burned through about $1 billion of venture capital money, and then did an asset sale to Roku for its content. And we've also seen interesting developments in recent years as a sign of the need for a systematic way to efficiently sell startups that have in some sense failed, but still have some value. There are now marketplaces like MicroAcquire, which are platforms that allow startups to list themselves for sale. So you have M&A as one exit path. Often a startup board that's looking for an exit pathway, it looks to find a buyer, but if it can't find a buyer, sometimes it'll find an option to do a deal at a smaller value in which the buyer is interested in hiring members of the team. And that's an acqui-hire, an acquisition that's being carried out primarily to hire a team of the talent. And in many of those transactions, the buyer has little interest in the assets or projects of the startup. And big tech companies such as Google, Facebook, and Amazon have been particularly active in the space. sometimes a company can't find an M&A deal or an acqui-hire, and it might have little of value, or it could simply just have not been able to find a deal, ran out of a runway, or can't raise more funding. And in those situations, companies are typically looking at a scenario where they just need to, in a sense, get rid of the company. And many of those companies do what's known as ABCs in the US, which is a state law insolvency procedure in which the debtor's assets are assigned to an assignee that's acting like a trustee over the assets. And ABCs are faster, cheaper, less public, less subject to oversight compared with a formal bankruptcy proceeding for a liquidation. So for startups, there are actually well-known professionals in this space who are in the business of serving as ABC assignees. One firm in particular is well-known, Sherwood Partners, that's handled ABCs and receiverships and bankruptcies for startups for almost 30 years in the Bay Area. For some companies, once they've explored M&A, acqui-hire, or they're not doing an ABC, they are simply in the position of doing some kind of voluntary shutdown or dissolution. The paper talks about a few other possibilities just to be thorough. Sometimes you'll see companies do recapitalizations or distressed turnarounds that are in some sense dealing with the failure of a company. It might be a recapitalization that gets out most of the original investors, et cetera. And that's really the landscape of dealing with startup failure. And when you look at this, you see that actually what's going on is looking for producing a return in value, but it also is largely dependent on the nature of the assets. There can be liability concerns and concerns about visibility and reputation. In many instances, the participants are trying to get rid of the company relatively quickly in a way that isn't too highly visible or salient and provides soft landings for the participants. So the argument of the paper is that you can really think of these as an alternative system. This is the system that we have for dealing with the large number of failed venture-backed startups. And that is crucial because out of this system that produces many, many, many failures, we also have some of the largest business successes in history. And by their nature, we're going to have large numbers of failure. There's nothing wrong with this kind of failure. In fact, if you have a system that's aimed at innovation in an environment of uncertainty, you're going to have that. We're not trying to produce fewer failures because we will naturally have them in this system. But the issue is that we need to have a good system for dealing with them because that will affect the whole system in larger part of encouraging entrepreneurship in the first instance, et cetera. And so what you see when you look at this world is really the theory of ex post bargaining that has been put out by scholars like Bill Bratton. And you see this happening in practice in the real world with specialists in venture debt, with specialists in assignments and liquidation, et cetera, that come in as players in this ecosystem to deal with failed startups. So I argue that there's advantages in the US to the way that we've developed both law and culture around this failure. We enable participants to fail with honor. When you start watching this space, you see that venture capitalists and entrepreneurs are often communicating these values with each other. Like, as I have on the slides, there's tons of this on Twitter. You can see people talking to each other and reinforcing these values. Startups might fail, their entrepreneurs don't, and their entrepreneurs do not. So you see the sort of thing that allows people to avoid reputational harm, protect their social capital, to quickly get into their next thing, to redeploy labor, talent, the tacit knowledge, avoid fees and expenses from lengthier processes or more formal requirements. And this fosters risk-taking and serial entrepreneurship. If somebody knows that, hey, even if I start a company and it fails, I probably will end up being able to get a job in a larger company. At some point, it's not going to affect my reputation. I might even get funding for another startup if this one doesn't work, and so on. There are also, though, downsides, I think, to a system that facilitates failure in this way and allows for people to get funded again and to get soft landings, et cetera, which is that the system that we have has a number of inequities in the first instance that if we don't have a diverse set of venture capitalists and entrepreneurs, then the same people might be getting second chances and so on, and it might not spread those opportunities. It could amplify the inequities, in other words. And in the paper, I point out that this gets highlighted and underscored by a bigger picture of understanding failure and the kind of soft landing system or failure with honor that we have. And so it provides another argument for dealing head on with dealing with issues of diversity or inequities in the venture capital ecosystem. There's been a number of recent examples of startup failures that I've been looking at, where you can see the cultural aspect of this, where you see, for example, a company named Fast recently failed, and Andreessen Horowitz, one of their partners, quickly tweeted out on the day that it got announced, "To the many great folks who worked at Fast, there are 12,000 job openings across the Andreessen portfolio. Many startups fail, so no big deal. Figure out what you've learned and move on. You know, come work at one of our other portfolio companies." Other people chime in. "I'm sorry Fast employees are facing this news. Thankfully, according to the information, some engineers will be offered work at a firm. If you're a Fast employee in operations, we're building a soft landing for you at this other company." And somebody from the company posting a list of all of the employees and their job titles so that they can get hired at other companies. So you see this sort of fast failure, failing at low cost, normalizing and redeploying the talent. This system that we've had in the US of dealing with this large number of startup failures might be coming under some pressure in that we're seeing new entrants to venture investing, mutual funds, private equity, et cetera, that might not be the typical players of past decades that participate in the same kind of cultural norms. Longer timelines of staying private and higher valuations and amounts of funds being raised means that we have more of these kind of larger startups that can be more difficult to find landings. There's been recent work by Abe Cable, who's produced a study that looks at what happened to the first batch of unicorns that had received a private valuation of $1 billion or more, and what paths they had taken. And what his findings show is what I point out, which is that they had some successful exits, but some were really failures and did ABCs or other sorts of M&A deals that were for less than the company had raised in financing. Those are hard to land, in a sense. And if we have more and more of those, which we do, most recently I've seen numbers of over 1,000 unicorns, it's hard to find successful pathways for all of those to find exits. And it may be harder for some of those to do these sorts of soft landings once they've hired many more employees, taken on much more money, et cetera. We also have looming increased antitrust scrutiny of big tech acquisitions that puts pressure on companies to find these exit paths, especially if they're M&A paths that would have regulatory review. So this system of dealing with failed startups could have some difficulty going into the future. We might see more companies using the formal bankruptcy system. I think this also has a number of policy implications in different areas of law, and that's what I discussed in the last part of the paper. First, on Delaware corporate law, there's two different areas of Delaware corporate law that I think are particularly notable in the failure landscape. And that's first the insolvency pathway, and the Delaware case law, and many venture-backed startups in the US are Delaware corporations. The Delaware corporate law on insolvency has evolved over the years, and most recently there's been a shift away from what was known as the zone of insolvency doctrine, and it's moved towards greater precision in defining the parameters of when creditors can bring fiduciary claims against the directors. And I think that doctrinal move to sharpen the line at insolvency might give rise to concerns about bankruptcy hardball and opportunism against creditors. But for startups, it's been very helpful because it helps mitigate the cost of ambiguous fiduciary law and reduces litigation abuse against startup directors. But a related area that I think could be further clarified and hasn't had much attention is that the test for insolvency itself is not clearly defined. And more specifically, it hasn't been explored how to understand that in the context of venture-backed startups. Venture-backed startups distinctively operate in a continual mode of raising staged financing and running down cash reserves, often while having assets that are difficult to value and questions about the reasonable prospects of continuing. So they're in a constant state of potentially being arguably insolvent. And that is just an utterly commonplace factual scenario for startups, and it opens up the regular possibility of creditor suits for breach of fiduciary duty, and also complexity for startup boards making decisions in an environment in which it might not be clear which path would maximize firm value versus value for common shareholders. I also point out, I'll just wrap up quickly, that the article's observations about the long culture of startup failure also puts the Trados doctrine about the preferred common shareholder conflict and the need for additional clarity into broader context, because scholars have often pointed out critiques about Trados primarily stemming from the observation that common stock maximization might not be the same as enterprise value maximization. And my descriptive account in this paper of the system for dealing with startup failure adds institutional detail for also understanding why common stock value maximization is such a difficult rule to navigate in practice. Because once a company gets into distress, it needs to do various things, and all of the options are actually very difficult and also pose fiduciary complexities. And in that sense, once you start to think about what they're actually doing, the exits with honor are serving a similar function on the downside that I think IPOs can function on the upside. They're a way out of a complex governance situation. It helps make sense of what we see companies doing. So for example, in M&A deals, you see preferred shareholders giving carrots to the common shareholders, even when they have no obligation to do so. You see acqui-hire transactions in which the employees stay together as a team, even though they could think more individually, and it gives something back to the investors in that way. But these exits with honor provide a soft landing and other benefits for the people involved that also gives them a way to get a relatively good outcome out of a bad situation in a sense. Finally, ABC laws states very widely in the procedures ranging from assignments under common law with little standardization to detailed state statutory provisions that have significant legal formalities. It's a big mix across the US. California has very favorable ABC laws for startups. And I point out that as startups are spreading to other states, especially with new hubs in New York and Miami and Texas, that those states could consider changing their ABC laws to be more favorable. Bankruptcy law could also take some insights from ABC laws and allow, for example, for choosing the trustee, so they could choose somebody that has more expertise in IP assets, et cetera. And finally, I think there's implications for antitrust regulation and enforcement. The discussions around increasing antitrust scrutiny often don't focus on protecting the system that we have for dealing with failure. And they're more focused on taking broad stroke approaches to trying to crack down on competition concerns. But I point out it's very important that when they try to do so, that they take a more finely tuned approach so that they don't impact the system that we have for dealing with all of the failures, because that also leads to the successes. Thanks.
Thank you very much, Elizabeth. We have Joan coming up with the first discussion. Just hand it over to you. Does it work? Okay, perfect.
Perfect. So thank you very much to the conference organizers for inviting me to discuss this paper. It's a great paper and it's a great conference, so it's a true pleasure to be here and share my thoughts on the paper. So just if I could very quickly summarize the paper in one slide. So Elizabeth starts with a very important and correct observation, which is that failure is the most common outcome for startups. As she mentioned, it's kind of difficult to really quantify it and put a precise percentage on this. One figure that I kind of inherited back when I was teaching at HBS and that I've been using for a while with my students shows the distribution of the returns earned by a top quartile VC firm over the course of 17 years in 468 investments. And essentially the purple bars, what they show you is the percentage of the invested capital, in which return bucket it ended up falling. And the pink bars, they show, the percentage of the value that they ended up receiving from their investments, from which kind of return profile they came from. And what you can see is that 63% of all the capital that was invested by this, top VC firm over this, 468 investments ended up going to what Elizabeth, and I think, that's the way how the literature thinks about this, will define as failures. So these will be cases in which the VCs lose money in the investment. And you can see how actually, these failures, sometimes the VCs are able to recover some of it, the various mechanisms that Elizabeth has discussed, but you can see how they end up accounting for just under 4% of the total amount of capital that the VCs end up making off their investments. And the bulk of the returns end up being produced by those very few, let's call them, home runs, that they just represent under 4% of the invested capital initially, but end up, representing over 62% of the returns where they get 10x or higher than 10x returns. So I think failure is it's the most common outcome, and it's one that we really need to understand well. I think Elizabeth makes a very compelling case in the paper, and she also made it in the presentation, and it's very consistent also with the way I've been understanding this process and the way how I try to pitch it, which is that bankruptcy is it's really not well suited to deal with most startup failures, with a few exceptions, which she does a great job at detailing, and that I might now add to my understanding of this phenomenon. But still, the idea is that in most failures, you are not going to go the bankruptcy route, whether it is Chapter 7 or 11, but instead you are going to see soft landing acquisitions, or kind of extreme version of this perhaps, which is what sometimes we call acqui-hires. You will see ABCs, assignment for benefit of creditors, or maybe some of the other less common mechanisms that she described, like maybe SPACs more recently. And the point that she makes, and I think is a very important one, is that these mechanisms allow startup funders to fail fast, efficiently, and let's say, with honor, or in a sense, without reputational harm neither to the entrepreneurs nor to the investors. At the same time, there's been a number of changes in the entrepreneurial finance market, let's say over the last couple of decades. That Elizabeth points out. So on the one hand, we've seen entry of new non-traditional startup investors from hedge funds, mutual funds, private equity firms, so new investors that go outside the typical VC fund or the typical angel investor. And we're also seeing delayed exits, and we are seeing in particular companies raising large sums of money, the kind of so-called unicorns, and becoming very, very big, while still staying private and while still raising private capital, and kind of without any plans in some cases to go public in the foreseeable future. And we've all seen, and Elizabeth pointed to this also, kind of increased antitrust scrutiny, and the concern that perhaps we are seeing these killer acquisitions, that some of these big tech companies are just buying startups, not really because of any synergies, but just because they want to kind of kill a potential competitor before it becomes too big of a threat. And I think kind of the point that Elizabeth makes in the paper, which I think is a very important one, is that these changes that we are seeing in the entrepreneurial finance market, they may disrupt the current, let's call it, failure equilibrium, that kind of has all these positive features that she described that allows this failure with honor, and that has been sustained by essentially long-standing relationships between key players who understand that they are playing a repeated games. And you can think about the case of a venture lender and the VC. Sometimes the VCs are going to make the venture lender full, even if they don't really need to, let's say, on a contractual basis, just because they kind of will expect to rely on this venture lender in the future when they need to bridge round for another startup in their portfolio. So why does this matter? This potential disruption of this failure equilibrium, this failure with honor that we seem to have, let's say, enjoyed in the US, for a long time, at least since the VC industry was well established. Well, as Elizabeth pointed out, the idea is that entrepreneurs and investors' expectations regarding the cost of failure are going to have a crucial impact in their incentives to take risk and in the first place, and to innovate and to participate in the kind of activities that, it has been very well shown that are conducive to a lot of the growth, productivity growth that we see in the economy. And in particular, if the cost of failure goes up because, creditors start playing hardball and they force companies into bankruptcy, or VCs try to, play hardball with the venture lenders, whatever the case might be, what you can imagine is that this will then lead to the incentives to take on risk and innovate to go down, and that can have these potentially devastating effects on the economy. In particular, even any changes that might come to this equilibrium, no matter how well intended, whether it is from the regulatory front or the smaller front, they can have important, profound, and unintended consequences. So I think this is a great paper. I think this is an important contribution that tries to really put together these two pieces of this puzzle, in a sense, the changes that we are seeing in the entrepreneurial finance landscape on the one hand, and then how these affect the failure outcomes. And this is important because, while, for instance, there's been a bunch of papers, myself, others that have talked, for instance, on how these changes in the entrepreneurial finance market, they've affected exits and how they've affected, in particular, the IPO decisions that firms do, the IPO route we saw until recently in the US. The Jobs Act was part, at least, a reaction to this lack of IPOs that we were seeing. We have seen much less of I would say, I haven't really seen any paper that has looked at how these changes in the entrepreneurial finance market have affected failures. And again, as she said, and as I also tried to show, failure is the most common exit outcome for a startup. And so really understanding how these changes that we're observing in the market can impact the way how firms fail, and how this will then impact the incentives that entrepreneurs have to take on risk and that investors have to fund them. I think that's something very important, and I think that Elizabeth does a great job at essentially, taking what I kind of see almost like the first step in thinking carefully about these issues. So I think I've said it. I think it's a great paper. It's very clearly written. It's very well researched. A great mix of kind of examples that really crystallize the ideas, and of course, very deep understanding of the legal issues behind here. The paper, it kind of fits perfectly in the conference. It's at the intersection of law and finance. I come from the finance world, so as somebody that comes from the finance side of this, law and finance debate, I can say that the finance part of the paper is so solid. I have nothing to add or to correct. I think that she's really understand what's going on here, and it's completely consistent with the way I thought about this. And the paper also is very nicely self-contained, and I thought it's kind of a super helpful primer on entrepreneurial finance, for scholars who might come perhaps from the legal world. They specialize in corporate bankruptcy. Perhaps we're going to see more bankruptcies with these very large unicorns on the kind of entrepreneurial finance side, and this paper can just kind of put you up to speed very, very quickly on some of the industry standards in this particular subset of the industry. So I think that's there's a lot to learn from this paper, and I certainly have. I just have one suggestion that kind of I will I thought it would be interesting if Elizabeth could kind of maybe tackle in the next version, or perhaps in another paper. One of the changes that we've seen in the entrepreneurial finance landscape that she kind of doesn't focus at the moment have been regulatory attempts to kind of expand access to private markets to regular investors. So essentially, traditionally it's been institutions and high net worth individuals, and we've seen a number of attempts to, in part because there's been this kind of fear of missing out, the private markets have become more important. Many of the most exciting companies in the economy are private. So there is this concern that maybe the regular investors don't have access to these companies. And, there's been a number of changes that have tried to facilitate this access. So crowdfunding that finally was kind of codified in the US in May 2016, kind of as a follow-up of the Jobs Act. There's been a recent expansion of the accredited investor definition. There was a recent Department of Labor decision that essentially allows 401k plans to add a private equity component to kind of the investment portfolio. And I think that these changes are completely understandable. Again, the idea is this fear of missing out by regular investors on these potentially very exciting investments. But my concern has been for a while, and again, I never formalized it, but what if kind of, let's say, the next Theranos involves regular investors losing substantial sums of money, either via direct investments, perhaps via crowdfunding, or just via 401k investments, instead of say Rupert Murdoch or Larry Ellison, which were some of the top investors in Theranos. Now, my concern is that this kind of having one very visible failure that involves regular investors and leads to congressional scrutiny and an outcry and these sort of things that, for instance, we saw around Enron and Sarbanes-Oxley, could kind of push private markets to push regulators to impose on private markets some of the same type of regulatory environment that we saw, for instance, post Enron with Sarbanes-Oxley applying to public firms. And in a sense, what this could imply is that some of the key reasons why these companies choose to remain private in the first place, because they like this kind of lighter regulatory environment, they like the differences in the way how they can communicate with investors, the kind of lighter disclosure regulations that they face, they could just go away in a sense because all of a sudden there is this outcry because some retired folks in Iowa lost a bunch of money in their private equity investments, let's say. And again, I think that if you think about, particularly with the growth in the supply of capital that we've seen with a bunch of investors entering the private markets, it's not obvious to me that the increase in the supply of actual capital that you gain by expanding access to kind of regular folks to this market kind of is worth the additional regulatory risk or uncertainty, however you want to kind of qualify it, that this increase in a sense generates. And it's not just me, I guess, thinking about this. Certainly there are signs that I think some SEC commissioners, Commissioner Crenshaw, Commissioner Lee, they are uncomfortable with the current growth in private markets and the comparatively light regulatory environment under which these private firms operate. And I think that in a sense we are just a disaster, we're waiting on it. So we just need one disaster or one kind of big case involving, perhaps regular folks losing money to kind of tilt the scales and end up with a potentially very, consequential and with many unintended consequences change in the regulatory environment for private firms. So I'll leave it here. Again, I think it's a great paper, interesting and timely topic. I think that we understanding how changes that we're seeing in the entrepreneurial finance market impact not just the IPOs or the M&A exit, but failures, which are the most common type of exit that entrepreneurs end up facing, is important. And I think that perhaps trying to think about this additional set of changes that we're seeing on expanding access to regular folks to invest in private companies and how this could kind of affect the political economy or the regulatory environment around private firms. I think that's a potentially interesting avenue to kind of dig a bit deeper. Again, I definitely recommend the paper and thanks for having me discuss it.
Thank you so much. Elizabeth, do you want to say a few words now, or shall we postpone after the second discussion?
I'll do it after. Thanks so much.
Okay, perfect. Then let's have the second discussion start. Okay, I see. Vincent Lazar, we'll hear probably a more practical perspective of the paper. The floor is yours.
Thank you. Hold on, let me make sure I can share my screen.
Does it work? Okay, perfect.
There we are. Okay. All right. So, well, first of all, thank you for having me. Good afternoon in Europe. Professor Pollman's research paper does an excellent job describing the startup culture and why in that culture failure with honor is so important. One aspect of that is a desire in that culture to have failure be a quiet, less visible process so that they can move along to the next venture. And so for the paper's premises kind of deal with that underlying culture. One of the paper's premises is that this failure with honor permits the startup entrepreneur to move quickly along to the next venture. Another premise is that the restructuring and liquidation regimes that we now have could be made more efficient. Again, there's a focus on maybe less visibility than you would see in a bankruptcy case. There is a specific section dealing with assignments for benefit of creditors, and then California ABCs in particular And then the suggestion that Chapter 7 might be adjusted to permit a trustee to be selected by the debtor, as we see in assignments for the benefit of the creditors. And I have reactions to each of these four premises that I'd like to go over now. With respect to failure with honor, in my opinion, that should not also mean secrecy or less visibility. Transparency, in my view, is a very important part of any formal process or regime, and I believe that it should be captured in any regime like that. Second, I question whether we really need different additional restructuring or liquidation tools. There are two additional tools that are not covered in a significant amount of detail in the paper that I'd suggest maybe should get covered in more detail. One of those is foreclosure sales, UCC sales, which we are seeing in startup failures regularly now. And the other is subchapter 5 of the bankruptcy code, a new provision that's about 2 years old. We don't have a lot of empirical evidence on it, but also seeing that used in startup failures a lot these days. And then I have two kind of more technical reactions. One is to the ABC process, which is admittedly efficient, but historically has also been susceptible to a lot of abuse, and question whether the paper needs to add some more discussion about that. And then a pretty strongly felt view that Chapter 7 trustees simply should not be selected by the debtor. And I'll get into that in a minute. So with respect to the notice and transparency issue, I'm a bankruptcy practitioner, been involved in hundreds of cases. Every one of these cases, I have companies management telling me that bankruptcy is going to mean a loss of customers, destruction of reputation, a permanent black mark, and with a handful of exceptions, that is simply not the case. People move past bankruptcy regularly and move past it with honor. Transparency is a hallmark of the U.S. bankruptcy system. And if there's a reason the startup failed, the entrepreneur is telling that story, whether it's in a bankruptcy or outside of a bankruptcy. And so whether we're talking about an ABC or a bankruptcy or any other formal process, in my opinion, stakeholders and the potential investors in the new venture should know why that startup failed and should be able to determine whether that entrepreneur was engaged in any improper conduct. And to the extent startups are using quiet restructurings and failure processes to mask the reasons for the failure, that transparency is not there. And so one of my suggestions is that the paper may want to consider addressing these competing policy considerations of notice and transparency. The paper does a very good job pointing out that, in fact, bankruptcy is not a good fit for most of these companies. Limited number of creditors, few tangible assets. You can't force employees and management to go work for a company. And no debt. Now, or little debt. I don't know if there's any empirical evidence on this, but at least what I'm seeing in the last couple of years is we're seeing many more startups fail with a material amount of debt. And so I wonder whether that is changing. And as a result, the tools that are being used are a little different than what we've seen over the last decade. The other point, and this is a very minor point, is just organizationally, a UCC sale that's a liquidation versus a going concern, and similarly in ABC, that is a liquidation as opposed to attempt to sell the business a going concern, are two very different processes. And so just in terms of the analysis of the transactions, you may want to consider whether that should be sorted a little differently. So I want to cover the two processes that we are seeing a lot of these days. Almost every bankruptcy I am seeing these days that typically would go through a Chapter 11 363 sale process. We see the debt holders pushing for a Article 9 foreclosure sale instead. Very quick, less disruption to the business than an ABC, and certainly less than a Chapter 11, significantly cheaper. And in most of these cases, they're friendly foreclosures. The secured party has already lined up the buyer. They, in many cases, are providing funding to the buyer. And so I don't know if there is data available, but if there is, it would be interesting to see whether there's information concerning the increased use of UCCC sales, especially, at least in my experience, as we're seeing more and more of these companies, the startups go into a restructuring situation with debt on their balance sheet. The other area where, understandably, there's very little out there in terms of empirical evidence is Subchapter 5, which went into effect about a year and a half ago, right before the pandemic. It's available to any business with less than $7.5 million in debt. It is a very streamlined process. There is a specialized trustee that looks at the company's viability. Very attractive for private equity sponsors or business owners because there is no absolute priority rule. So the equity can retain their ownership interest in the entity, and you don't need creditor approval to do it. It also provides important protections that you can't get outside of a bankruptcy process. And so we are seeing more and more companies and startups that have typically a limited amount of debt in the first or second stage, turning into Subchapter 5. And again, as I indicated, I don't know whether there's empirical evidence, but certainly talking to some of the judges that are seeing these cases and the practitioners who are filing these cases, they seem to like them a lot. So I skipped a slide, and I will apologize. I'll come back to the ABC process. The research paper explains very well the benefits of assignments for the benefit of creditors and the California ABCs in particular. Hold on, let me see if I can back up this slide. Oh, I figured it out. And most ABCs are in fact legitimate, legitimate attempts to restructure or sell the business. However, historically, ABCs have had a little bit of a bad name because they are completely out of court. There's very little transparency, and so management can hide questionable transactions, transfers to insiders. Assignees typically have weak clawback powers, and the marketing process is often anemic in these ABCs, and so it often can be steered to a preferred buyer by the owners of the business. And so while ABCs are popular, some of the reasons they're popular are not entirely legitimate, and so I question whether we should, the author might want to consider adding some of the criticisms. And again, like I said, this comes back to my transparency theme. All right, and then finally on the Chapter 7 trustees, Chapter 7 has really become an absolute last resort. It is a situation where the company has run through every other option, including Subchapter 4, UCC, M&A, anything you can think of. And so they really very rarely these days involve any meaningful assets, and that includes IP assets. And so, some of the older resources where we used to see Chapter 7s being used to liquidate assets, I question whether those resources are still as accurate, simply because what we see in a Chapter 7 is literally closing the doors and nothing of value to sell except maybe some furniture and equipment. So against that backdrop, I really don't see anything to be gained through the debtor selection of a Chapter 7 trustee. You run into instead the same problems we see in some ABCs, where when the debtor is selecting its own fiduciary, there's always a perception that that fiduciary will not do a full investigation and bring the types of claims it might otherwise bring, and that there's a potential for abuse or favoritism. And particularly with the adoption of subchapter 5, I'd be curious as to the author's views on whether that impacts her position on the trustee selection issue. So with that, thank you for having me, and Professor Pollman, look forward to your reactions.
Thank you. Elizabeth, do you want to?
Yeah. Thank you so much. Well, I was long in my presentation, so I will try to be very short in my response, but most of all, I want to say thank you so much to both the commentators. That's amazing comments, both really valuable in different ways. So thank you so very much. I have taken extensive notes and also some screenshots. I'll just respond to a couple of things in particular that stand out. One is that I've been puzzling over this idea of failure equilibrium that came up in the first set of comments that I think is really insightful, to even put it in those terms of a failure equilibrium. And it's something that I've been wondering, do we have one? Is it possible to know what the right one would be? Do we have enough of facilitating the failure? Yifat put in the comment thread that I saw, maybe it's become too easy in some ways to fail. We have a few bad actors that have gotten a bunch of headlines. So I think that's a really interesting theme. In some ways, I'm making some assumptions around the value of facilitating failure. So I think there should be a lot of that facilitation because that's part of what drives our system. But I think it's really hard and maybe even not testable to know what the right amount is. So I really appreciated the way that you put that, because I think that it was really well done. And I also thought that your comment about the private markets and potential SEC regulation is a whole other avenue that I could explore with this paper. That you said is nicely self-contained, which I appreciate. But I have thought about that in some other work, and I hadn't thought as much about it here. So I appreciate that. Maybe I'll be able to add something concisely. And on the second set of comments, there's so much there. Thank you so much, Vincent. So on the ABCs, yeah, I very much want this to be balanced analysis. I think that the California laws, one problem is that even us researchers can't access the filings. You'd have to go, I think, by county for paper versions. And that is a problem. So I think to the extent that we were to try to do changes across other state laws, we would always want notice to creditors and other things. And I think likely we want more ability to even access these filings. And I could do more to put that in the paper, I agree. And on the Chapter 7 trustees point, there's so much more to say, but I'll just say this is one last thing. I want to give credit to Ronald Mann, who first suggested that. I pointed out as maybe something incremental that might help with the bankruptcy system for adjusting it to make it a better fit for startups. But perhaps you're right that maybe there isn't that much to be adjusted in a sense, or maybe subchapter 5 is the better version of that. And really, it's just a matter of thinking about the other ways that startups are failing. And if so few are using Chapter 7 anyway, it's really just a very incremental thing. And the more emphasis should be on the other points that I'm making, because I agree, that's really a very small point of it. And in some ways, it wouldn't help that much. Yeah, but there's so much there. Thank you very much.
Okay, wonderful. Yeah, then I would suggest we move forward to the fourth paper.